Well, hello and a very warm welcome to another in our series of Choice Words videos where we get to speak to key decision makers from the world of UK fund selection, UK fund research and find out what makes them tick. I'm Julian Marr, I'm Editorial Director of Wealthwise Media, and today I'm delighted to be talking to Luke Hyde-Smith, who is Co-Head of Multi-Asset at W1M. Hello, Luke.
Good morning, Julian. Delighted to be here.
Oh, that's good energy. We like that. That's good. Good start. Let's jump straight in. What excites you? You sound excited already. What excites you about the current investment outlook, and what gives you pause for thought?
Yeah, I think we would frame our sort of current positioning as cautiously optimistic. If you think about two of the big drivers out there for asset markets, economic growth, inflation, both look actually in reasonable shape. We've got okay growth, depending on where you look around the world, and inflation, having been a major problem for certainly developed economies over the last few years, does look like it's coming back within touching distance of those central bank targets. So those two big factors, I think, look pretty constructive for asset markets. You then look at the earnings picture for the equity market. Again, that's been very robust this year, and I think is one of the reasons that the equity market has been probably stronger than many people expected at the beginning of the year. So, when we look out across the asset classes, be it equities, be it fixed income, be it alternatives, we can find plenty of bottom-up opportunities that really meet our investment criteria. So, we think there's plenty of opportunity, but to your second point, risks, plenty of those as well, right? So one of the big risks out there is valuation. Clearly the US is trading at pretty toppy valuations, or certainly parts of the equity market pretty toppy. If you look at credit spreads and the fixed income market, again, that looks pretty tight in terms of where spreads have traded relative to history. So there's a valuation risk. And then secondly, big risk out there with AI. Is it a bubble? Are these earnings going to come through, et cetera? And then the final risk that is very, very difficult to time is, fiscal concerns and fiscal sustainability of developed market economies and those levels of debt which have come into focus over the course of this year.
Excellent, great start. You mentioned bottom-up opportunities. I won't ask you any specifics because while I like winding up compliance, I appreciate not everyone does. So let's not go be too detailed. But what do you most look for in an individual investment, and what do you see as red flags? Yeah,
so if I sort of split out what we look for by the asset classes, so on the equity side, we really try and focus on four key criteria. Mm-hmm. The durability of a company's earnings, how sustainable can they be, and can we have real confidence in the growth and the ongoing delivery. We look for the opportunity, so how large is the opportunity for that company. We look for alignment, so are the management team aligned with that success, mm-hmm. and are we then aligned as shareholders with that success. And valuation, very, very important. You don't want to be overpaying for that opportunity if you've identified it. If I think about the fixed income opportunity, we look at credit, we look at duration, so the length of the maturity of the bonds, and then clearly currency is an important factor. And then finally on the alternative side, looking at real assets, really we want to own unique assets, unique locations run by really high quality management teams. So that's kind of how we frame what we look for. What would be a big red flag for us? Well, I think anything on the governance side, if we have concerns over governance, management, alignment, etc., that's a big red flag. I think a big change in management team, be it from a third-party fund or be it from an individual company, if there's a sea change, unexpected sea change, that really warrants a lot of further investigation and research. And then, big changes in style, right? So if a team, management team, etc., change their focus materially, that's a bit of a red flag for us.
Excellent. You're doing a great job of just setting me up for each question here because you mentioned alternatives. To what degree should professional investors and their clients be thinking beyond the traditional asset classes and thinking more alternatively? And what would you consider to be the ones they should be looking at?
Yeah, we've spent a lot of time at W1M thinking about portfolio construction. We've actually used alternatives in portfolios for a number of years, if not decades. Now, if we consider traditional portfolios, traditional assets, your 60-40, 60% mm-hmm. equities, 40% government bonds. One of the things that we've been discussing with clients, and I'm sure you've had people on before discussing this, is this correlation between equities and bonds, right? We have been through, up until 2022, when it came spectacularly unwound, an environment where equities and bonds were negatively correlated. So bonds, when there was an equity market wobble, came to investors' rescue. They not only delivered returns, but they performed when equity markets declined. Now 2022 came along, big drawdown in equity markets, and actually the bond market drew down even more. And what you've seen is a bit of a continuation of that trend, i.e. bonds and equities have been moving in a similar direction. We think that is due to a slightly higher inflationary environment, and we think alternatives in their broadest sense, be it absolute return real assets, can help deliver better, more consistent portfolio outcomes, clearly bring in some diversification, but it's not just about protecting. We want our alternatives exposure to deliver genuine returns, and importantly try to do that in an environment where particularly the fixed income market may struggle, and that goes back to that earlier point about fiscal concerns, those bond vigilantes. Where are yields going in this current environment as we look out?
Excellent, great answer. More personal question now. What was your path into investment, and in an alternative universe, if you hadn't taken that path, what do you think you'd be doing now?
Yeah, well, I'd love to say I had this, very unusual path into the investment industry, but it was pretty traditional. I studied a finance degree, but actually, upon finishing that, I didn't go sort of straight into the city. I actually took a year off. I went traveling. I did some community work. I did some teaching, but you don't get an opportunity to begin a career and have a finance degree all that often. It obviously comes around once in your life, and I actually went off to the Channel Islands and got myself a job there in an investment department. And having thought the office life and finance, etc., could be rather boring and is not where I wanted to spend my time, I had a great mentor there, and I just found the world of investment totally engaging. I got started on the CFA, which wasn't quite as engaging, but it was very good background, and I really felt that learning about markets, about the interaction with people, about how economies, markets, the behavioural aspect of it all worked was fascinating. And here we are 20 odd years later, still learning, still finding it totally fascinating. If I wasn't an investment professional, what would I be? I mentioned moving to the Channel Islands. I love the sea, sailing, etc. One of the careers I sort of thought of following would be working in, or indeed owning, a vineyard that you can own for fantastic locations, really interesting, engaging job, and if it all comes to pot, you've got a great product from great produce to drink at the end of the day. So you never know, I might end up doing that in retirement years, but that was probably a career I may have followed.
Excellent, we will keep in touch just in case, you never know. Still looking backwards, what is the biggest investment mistake you are prepared to admit to? What did you learn from it?
Yeah, clearly we don't get all these investment decisions correct. I think I would highlight our investment in Home REIT as our biggest mistake. We unfortunately invested in that company and we learnt a lot. I think, a lot of the things that we actually went through in terms of diligence and the research of that company, we couldn't have done a lot better. It's incredibly difficult. Thankfully, it was only a small position. And I suppose one of the things we learnt from that was there's a large amount of money raised very quickly. That was then put to work very quickly. I think we could have been more detailed in our analysis of that and our coverage of that name. But safe to say, in terms of lessons, I think it's going to be much harder for companies to, certainly in that space and in the investment company market, to IPO, because that company was a total disaster from an investment standpoint, and clearly very, very disappointing outcome.
But those are interesting, aren't they? Because to a large extent, as you say, investment is so much more about process than it is about outcome. Would you do the same things again? And then almost, if someone's being like that to you, then you almost feel, God, I might make that same decision again. And that's quite a worrying state of affairs. So, speaking of risk, as I'm now feeling we are in the realms of, how would you explain risk to someone who doesn't work in investment?
I think this is actually relatively simple and really goes to the heart of how we describe risk to our clients. We frame risk as the probability of permanent capital loss. Right? And I think most people can understand that. When we explain, we are seeking, obviously, to deliver a return in keeping with the level of risk that we describe to clients. And what we want to avoid is any long-term and permanent capital loss. I think any other description of risk, and there are many of them out there in the investment industry, who's done an incredibly good job of complicating it and bringing in all sorts of jargon, are secondary in nature. So I would say the fundamental definition of risk, as we describe running our multi-asset strategies, is that risk of permanent capital loss.
Very good. If you were head of the FCA for a day, not mentioning the words home or REIT, what would you do?
Yeah, well, this would go to my small megalomaniac tendencies.
Okay, good.
Okay, so I think I would answer this in two ways. What might actually be possible in a day, and what might be feasible if one had a magic wand.
No, I like that.
Okay, so let's deal with what might be feasible in a day as head of the FCA. I would ensure that, from a regulatory standpoint, the UK treats UK-listed investment companies as they are treated around the world as other listed shares on exchange, both from an investment standpoint and also a reporting standpoint. The investment company sector is a great sector, is a leading long-term investment structure for the UK. It's been incredibly successful, but is under a huge amount of pressure at the moment. And I think easing the regulatory burden from reporting would be an easy way to instill some more confidence in that market. So that's what I'd do day one. In terms of if I had a magic wand, I'd want to instill a bit more equity culture into this country. I think, we seem to be in an environment of reducing risk rather than maximizing returns. And I would sort of frame that, if you look at the pension schemes, large holdings in bonds over equities. If you think about individual savers, large investments in cash ISAs rather than the equity market. So this is a hard one to solve, but as leader or in charge of the FCA, instilling more equity risk-taking culture in savers across the UK would be a great outcome as head of the FCA.
That's excellent, and it's unfair of me to reward you by throwing in a random question, but you mentioned investment companies. They do feel to be on the ropes. You talked about from a regulatory point. What do you think the industry can do itself to help investment companies, both as investors and the companies themselves? What would you be suggesting there? I'm sorry to spring that one on you, but
no. I think it's an important question because they are on the ropes. I think one of the things that we've been very active in is improving the governance, right? So I think boards could do a lot more to ensure they are acting on behalf of shareholders rather than perhaps the management teams. I think we have to, this goes back to this sort of saving and investment point, right? These are fantastic vehicles, right? Not all of them are great. Some of them, clearly you have to find the management teams and the underlying assets that you like. But I think trying to ensure that investors, be it wealth and investing firms such as ourselves, be it the retail platforms, be it the pension funds, making investment companies more attractive to invest in for them would instill more shareholders coming to the market and thus, I think, support the share prices, which, as you know, are trading at quite significant discounts to NAVs in the majority of cases, which is, a problem. And this goes to, this is a big problem. It's not just the investment company sector. The UK market overall is somewhat on the ropes. And how can we instill more international investor enthusiasm for the UK market is a big question, probably longer than we've got time for today. But the sort of regulatory backdrop, the desire to make investing in UK equities easier. We could think about, for example, reducing stamp duty on share purchases, right? It is an outlier. In the US, you pay 0. UK, it's 0.5%. We're very high versus many other jurisdictions. And that's just one example of it's just being a little bit incrementally negative for investors to invest in the UK.
Yeah, it needs to make it less of a no-brainer, but just, we live in hope. Everyone's favourite question on choice words. Outside of work, what is the strangest thing you've ever seen or done?
Oh, I saw this question come through, and I thought this was an interesting one. And I was sort of pondering this, and I thought, actually one of the strangest things that I've seen, and my 7-year-old son probably won't thank me for bringing this up, but most babies, when they grow up, they sort of begin to crawl, and they sort of crawl in a straight line. Jack suddenly started crawling in this sort of crab-like crossway stance, and he was incredibly good at it. He was very, very quick, and you may have seen many other babies or kids growing up doing it, but it was quite strange, and we got quite a lot of comments saying That is very unusual. And thankfully, Jack is now 7
And he's not
walking,
walking.
walking in a straight line.
Walking forwards, aren't
Yeah.
they?
So that's good. So
Yeah.
we seem to have moved on from the crowd chase, but yeah, it was quite strange.
Okay.
A little bit of a concern as a parent.
No, I can imagine. And on the bright side, sadly, the choice words viewing demographic among 7-year-olds, our figures are not as high as I would like, so you're probably safe, and I think Jack won't get to see that anytime soon. Last question then. We call this choice words because of what you do for a living, but I'm now looking for a couple of recommendations. One of them is for a book. It doesn't have to be an investment, but it can be. And the other one is a free hit on anything. Words of wisdom, restaurants, podcasts, vineyards, wherever you like.
Yeah. A little bit of a cheat, if I may. On the book side, I'd like to suggest 2 books, one with a little bit more of an investment lens and one less so. Something obviously one gets asked every now and again, what would you recommend in terms of books? Where should I start if I want to get into investment? I think one of the best books out there, written by Sebastian Mallaby, is More Money Than God.
Okay.
It sort of describes the chronology of financial markets through the lens of the most successful investment firms of the time. So, it starts in the 1920s and takes you through all the decades and all the crises we've faced, and also how the financial markets and the firms that operate in it have evolved. So it's a great read. Sebastian writes it incredibly clearly and is a real sort of whistle-stop tour of how capital markets and indeed the firms that operate in it have evolved. The second book I'd recommend is Born to Run. McDougall, is it? Yep. And that's a great book. I think it's just a life-affirming read about running. I enjoy getting out there and doing running, and I think it's just a great read, and people will enjoy how it's written.
Good stuff. So those are your 2 recommendations.
And then the recommendation and the final
No.
one, so for sort of my sort of freebie, if you like, I think healthy body, healthy mind. If you want to operate in this investment world, it is pretty intense on occasions, particularly mentally. And in order to stay and fulfill your role, I think to your best ability, you've got to try and stay healthy. And I think that's a really important asset, if you like, to ensure that you're on top of your game for the investment world and can really deliver for clients and your colleagues.
Yeah, it sounds promising. Too late for me, but it's good advice for everyone else, I'd have thought. Well, great choices. Luke, thank you so much for that. Thank you so much for all your answers and for this conversation.
Julian, it's been a pleasure. Look forward to keeping in touch.
Yeah, absolutely, especially on the wine. And thank you all very much for watching. Please do look out for further Choice Words videos as they are published.